Let's dive right into this explainer and untangle the complex rules of IAS 21 so we can see exactly how businesses handle fluctuating global currencies without, completely pulling their hair out. If you've ever wondered how multinational corporations keep their balance sheets actually making sense when exchange rates are jumping all over the place, well, you're absolutely in the right place. We're going to break down the exact standards governing foreign exchange transactions, keeping things super clear and focused every single step of the way. Here is our roadmap for today. We'll follow the true life cycle of a transaction, starting with the three currency types, figuring out your functional currency, tackling day one recognition, managing year-end monetary and non-monetary items, and then we'll wrap it all up with a practical euro purchase example to really lock in that understanding. All right, section 1, the three currency types. This is about building the foundation of IAS 21. Because if we don't get these basics right, the rest of our accounting completely falls apart. The crucial point here is that a business can have multiple foreign currencies and multiple presentation currencies, but it only ever has one functional currency. Think of this as the actual heartbeat of your financial operations. It's the currency of the primary economic environment where your company lives, breathes, and operates day to day, regardless of whatever different business segments you might be dabbling in. By default, any currency that isn't your single functional currency is classified as a foreign currency. It's that simple. For example, if you're an Indian student paying your ACCA exam fees in British pounds, but your functional currency is Indian rupees, those British pounds are completely foreign to your primary economic environment. And then we have presentation currency. Think of it like this. Your daily operations are running on your functional currency, but your investors, or maybe the stock exchange, well, they might need the numbers translated into something else. It's literally just the language you choose to present your final numbers in to the outside world. Moving to section 2, finding your functional currency. How exactly do we determine this all-important primary economic driver? It's not always as obvious as just looking at where your headquarters is physically located. You've got to look at the primary factors first. Think about the local competitive forces driving your sales. What currency actually dictates your selling price? What currency is paying for your labor and materials? If those primary factors aren't painting a clear enough picture, only then do you dive into secondary factors, like the currency generated from your financing activities or your retained operating receipts. And look, you can't just cherry pick one metric, call it a day, and walk away. Management has to look at the holistic picture to justify the final functional currency. These factors aren't simply checkboxes. They're the hard evidence you have to weigh to prove exactly why a specific currency acts as your primary economic driver. Let's hit section 3, day 1, initial recognition. We are now entering the life cycle of a foreign transaction on the exact day it occurs. This is day 1, the moment the deal actually goes down. The rule here is wonderfully straightforward. You identify the exact date the transaction takes place, you find the spot exchange rate for that specific day, and you record it. Boom. If you purchase goods and you settle the payment immediately, the transaction is closed right then and there. Any immediate differences are treated as a realized gain or loss, and there's nothing else to worry about. But wait, what happens if you don't settle the payment immediately? That unresolved payment is where the true accounting challenge of IAS 21 actually begins. You bought the goods today, but maybe you aren't paying the invoice for another 3 months. Let me tell you, the exchange rate isn't going to wait around for you. Which brings us to section 4, year-end monetary items. Fast forward a bit. Let's see what happens when year-end arrives and we still have those unpaid foreign invoices sitting on our books. First off, we have to classify this unresolved transaction. If it's a fixed amount of cash that we owe or that is owed to us, it's considered a foreign currency monetary item. Common examples: your standard loan receivables, loan payables, trade receivables, trade payables. Basically, you know exactly how many foreign units are eventually going to change hands. The rule here is beautifully simple. At every reporting date, you absolutely must restate your monetary items at the closing exchange rate. Because the rate has moved since day 1, your balance is going to change. You take that difference, which, keep in mind, is an unrealized foreign exchange gain or loss since no actual cash has moved yet, and you dump it straight into your profit and loss account. Section 5. Year-end non-monetary items. But what if the asset we bought is a non-monetary item, like a massive piece of property or heavy machinery? We aren't receiving or paying fixed cash for this. We just hold the physical asset itself. Here is where your accounting policy splits the path. If you keep the asset on the cost model, you do absolutely nothing at your end regarding foreign exchange. Seriously, you just leave it alone, it stays frozen at the historical transaction rate. However, if your policy uses the fair value model, you're forced into a recalculation. This step-by-step approach ensures you never mix up the historical rate with the valuation date rate. First, you determine the new fair value in the foreign currency. Then, and this is absolutely critical, you convert it into your functional currency using the exchange rate that existed exactly on the date that fair value was determined. Don't mix up your dates. Once you have your difference, where does it go? Usually, it just follows the asset standard rules. Property, plant, equipment goes to other comprehensive income, or OCI. Investment properties go to P&L. But here is a massive curveball you need to memorize. For fair value through OCI equity shares, that foreign exchange gain or loss uniquely bypasses OCI and goes straight to P&L. Do not put the Forex difference for those specific shares into OCI. All right, let's bring it all home with Section 6, the Euro purchase example. We're going to dive into a real-world scenario with Min Company purchasing goods from a Dutch supplier to see exactly how these rules connect. Notice how this specific transaction bridges right across the financial year-end on December 31st. Because that final installing isn't actually paid until January 1st, we're going to have a trade payable just sitting on the books at year-end. And as we know, that triggers our monetary item restatement rules. Let's say on day 1, November 1st, our spot rate is 1.63. Min Company is operating in dollars, but they are buying in euros. The practical math really just comes down to this. Ask yourself which currency is stronger. Since $1 buys 1.63 euros, the dollar wins. Therefore, converting the 50,000 euro payable into your stronger functional currency means the number should go down. So you divide by 1.63. That gives us an initial trade payable of $30,675. That goes on the books and the purchase hits the P&L. Come December 31st, we simply grab the new closing rate, run this math again on whatever balance is left, and push that difference directly to our P&L as an unrealized foreign exchange gain or loss. And remember, once the invoice is finally paid in cash on January 1st, that final difference becomes fully realized. So I'll leave you with this. How much profit could your business be quietly leaking simply by holding on to unsettled foreign payables at year-end? Exchange rates literally never sleep, and an unresolved invoice is essentially an open bet on the global currency markets. Think about that the next time you apply IAS 21 to your international transactions. Understanding the exact flow of functional currencies, spot rates, and year-end restatements isn't just about ticking compliance boxes. It's about protecting your bottom line. Thanks for joining me on this explainer.